This simple line representing a decline in volatility can sometimes be preferred when other information from the regular Bollinger Bands is not necessary. And you may have already noticed this, but the Bollinger Bands Width and the regular Bollinger Bands indicator are not indicators of market direction, such as in this case where price goes down while the indicator's line goes up. Volatility expansion or increase can be likened to potential strength for movement, which can be going down, up, or simply horizontally fluctuating, such as right here immediately after the gap down. When there's a decrease, also called a contraction of volatility, stronger movement at this current time is low, and it's likely a pause before the build-up to more major movement once volatility inevitably increases once again. Choosing to use one indicator over the other, or using both at the same time, is a matter of personal preference concerning how changes in volatility get presented on the chart, and whether or not you want the information from the median along with the upper and lower bands of the regular Bollinger Bands indicator. See here a regular gap up, just with the regular Bollinger Bands indicator alone. Now add the Bollinger Bands Width indicator. You can observe for yourself which one you prefer to indicate changes in volatility. From November to early December is a good example of volatility still being able to rise after a gap up. Now the opposite with a gap down, where it may actually be slightly easier to see the contraction of volatility first with the Bollinger Bands % width indicator, since its appearance doesn't get distorted as much compared to price and the Bollinger Bands indicator, which have to scale on the chart.